what is driving these investors, foreign investors, to come and invest in mid-sized banks, particularly?
If you look at the investments which is coming, these are mostly coming from Japanese or Middle East banks.
Traditionally, we have seen that multiple NBFCs in the upper layer category are promoted by a corporate house. Now, I believe with your commentary and with the commentary that he has made last week, I think there is a fresh thought to it.
My sense is that there might be a rethink on that, and with the system becoming stronger, the stronger supervisory framework, governance standards improving, you might see even the corporate at some point of time the regulators rethinking on that piece as well.
Hello and welcome to another video podcast of Current Account. My name is Piyush Shukla. Today we have with us Prakash Agrawal, who's a partner in Gefion Capital, which is an investment banking firm specializing in tailored financing solutions for its clients. In his last role, he was the Senior Director and Head of Financial Sector Institutions at India Ratings and Research, where he built and led a large franchisee in the financial institutional space. Prakash sir has been, he has worked extensively in the finance domain, gives a lot of briefings to regulators on different developments in the financial sector, helping them design regulations. He is also the author of several pieces on regulations and banking supervision. Sir, thank you for your time. I want to pick your brains on a couple of evolving aspects in the industry. For starting with, we have seen, sir, recently a spate of acquisitions of not spate. There are two acquisitions by foreign banks, substantial stake. One is SMBC picking up around 24% stake in Yes Bank, and we also saw Emirates NBD Bank coming in and proposing to purchase a majority stake in RBL. So this is a two-part question. First is, what is driving these investors, foreign investors, to come and invest in mid-sized banks particularly? Is it because they're non-promoter driven? What is the opportunity they see in Indian banking system? And from a regulatory perspective, do you feel the RBI will approve these transactions? Because that is still pending. RBI has given for SMBC, but the ENBD deal, which is first of its kind, do you feel the regulatory approval will come in?
Yeah. Thank you, Piyush. Thank you very much for hosting me on this. Always a pleasure talking to you. I think it's a very pertinent question. If you look at India today, it's in a very sweet spot. In the sense that almost, if you look at overall global geographic conditions, our country's GDP is largely composed of domestic consumption. So in a way, we are less impacted by the overall volatility which we see across in the global arena. On the second piece, if you look at the investments which is coming, these are mostly coming from Japanese or Middle East banks. These are the countries where the growth is somewhat limited. The banks are fairly well capitalized. They're looking for the growth markets. If you look at last 10-15 years, most of the European and American banks have either winded up or reduced their operations in India. Not necessarily because of the Indian consideration, but because of the global restructuring, regulatory, complexity, the returns which they thought were not adequate. From that perspective, India offers a very good market for Japanese and Middle East banks to come and expand into this. Some of these investors also look that they could add a fair bit of value addition in the Indian context. They don't only bring in capital, which is of course there, which helps in scaling up, but they also inject discipline, advanced technologies, global governance standards, and they also open up overseas markets for these domestic banks. So it's a combination of financial strength and innovation which can make some of these banks much more competitive and strong. So these are fairly, I would say, fairly strong incentive from both the sides, both the capital provider and the banks which are taking capital to kind of tie up on this side. Yeah. From the approval perspective, I think, yes, there is a growing acknowledgement among the regulators that Indian financial system today is far more mature and resilient and therefore capable of accommodating greater flexibility in the shareholding structure. Historically, restrictions on ownership and voting rights were primarily driven by the governance concern. Given that the banks are custodian of public deposits, we also see that the Indian economy is expanding, and that the sector requires far more stronger institution. And we require a patient capital from that perspective. So, from the long-term perspective, this long-term investments and the credible names does provide both are desirable and probably necessary, I might say. I would probably expand it in a way that if you look at two things, the government has been articulating that India needs much larger banks, much stronger banks, and there have been talks about merger of some of the PSU banks in the field. So there was a time when the government or the regulators used to think there's multiple banks based on area, geography, certain features. I think the outcome has been mixed from that perspective. Now there's a thought process that we need a much larger, bigger banks which can cater to the requirements of the domestic economy. And the final point, I'll probably see that there was a very clear articulation from the regulator side that they would not allow private sector corporates into the banking segment. My sense is that there might be a rethink on that, and with the system becoming stronger, the stronger supervisory framework, governance standards improving, we might see even the corporates at some point of time, the regulators rethinking on that piece as well.
That is a very interesting sort of statement that you made, because just last week SBI conclave DFS secretary had said that we need more banks in the country. How do we get more banks? First is we have NBFCs who can convert to banks, and then there are SFBs who can be upgraded to a universal bank. Now, traditionally we have seen that multiple NBFCs in the upper layer category are promoted by a corporate house. Now, there I believe with your commentary and with the commentary that he has made last week, I think there is a fresh thought to it. Also, because we are talking about foreign investors coming in, I wanted to get your views on the long pending. I understand there is a particular transaction, but as a veteran in this space, I want to understand what happens with IDBI, because the names that are floating around included those of ENBD was one of the bidders apparently. Then there is Prem Vatsa Fairfax. Then there were also talks about SMBC. Now SMBC and NBD have both invested significant amount in other two private banks. Kotak's name is also going around. Do you believe IDBI's privatization will go through in this financial year, or the tail will continue? Because we have been for the last couple of years hearing about and also whether the government will go for the second round of merger. What do you feel?
Yeah, I think very interesting question. I mean, your guess is as good as mine. How long will it take for privatization of IDBI? But it's one of the case where government was also exploring. In case at some point of time, if the sector was to be more liberalized and you want more private money to come in sector, probably this would have been a fit case to understand how the things will form up. From the perspective of various, I also kind of heard similar names in the market, but I would just few points from my side. I would probably think I would probably think that some of the banks, like for example, the banks like NBD, which is already kind of proposing 60% stake in RBL, I would be a bit skeptical to believe that they would probably invest in two banks and take exposure in two separate banks. They would probably want one of the bank. Similarly, SMBC has already taken exposure in this bank. The name which you spoke about, Fairfax, they have already have a very large stake in CSB. My understanding is that the experience have been somewhat mixed in that. So, for a bank of this size to be taken over, there has to be some, I would say some accommodations from the regulator side as well. And there will be a discussion in terms of what form, shape, how the capital will come in with the existing shareholders like LIC and government they have to be will they exit, or it will be a dilution of shareholding. I think there are many considerations to that. And then it's a very large bank. So I think this is a mammoth exercise in itself. and there would be a lot of discussions happening at all the levels, both at the regulator and the government. So it's not an easy exercise to complete, and it's fairly understandable the time taken for this exercises today. So, but I do understand that there have been a fair bit of focus from the government side on this issue, and they have been fairly flexible in terms of discussions and names. But yes, I think there is a fair bit of progress happening on that. Whether this consumes in this financial year or next year, I think that I would probably not want to hazard a guess on that side.
Second round of PSB merger, is that on the card? Because government is talking about bigger, larger banks, and will mergers creating one large bank, will it actually, the point is to fund the infra growth. The last leg of legacy asset, crisis that we saw, which led to AQR, was because of the legacy, this pile up of infra sector loans. Will bigger banks actually, make a meaningful difference? And do you feel the government is likely to go for a second round of PSB mergers?
Yeah, I think so. In the sense that, if you look at the Indian economy as such, it's a fairly growing economy. We need, lenders or the capital providers who can actually support the requirements of the economy in that sense. The larger banks come with larger balance sheet, stronger risk management capabilities, more diversification. So the ability to write larger checks is also much stronger in that sense. And what you also need to see from the perspective that multiple banks, if they are doing the similar kind of thing, is more of there is limited value addition in that. It's only creating inefficiency. A larger bank probably could create a stronger, efficient model in that sense. And I think there have been articulations from the government side that they are looking for a larger bank. In fact, I think if I'm not wrong, there was an articulation from the government side that they would want a couple of banks among the top 10 banks globally in that sense. And one of the way could be, merging from these two large banks and create that capacity. So I would probably think there's a fair bit of discussion happening on that side. There's a fair bit of thoughts going on that side for making some larger banks, and where their synergies are stronger. Whether of course government has to probably also look at local, regional aspirations in that case. Which banks could be merged without creating a lot of I would say a lot of uncomfort in that thing. But yes, I do think that there are discussions happening on merger of some banks. I would probably like to believe so.
The 10th largest banks, among the top 10, there are many Chinese and US, and the 10th one is Japan's Mitsubishi with $2 trillion asset size balance sheet. So it remains to be seen the true scale that our banks gain. Moving on to the last MPC policy survey, saw so many 21, 22 odd banking specific changes that have come in. Of course, the major ones include allowing banks to do M&A financing. Also, this 10,000 crore ceiling which was there for bank funding to corporates, that also now, of course, there are each sectoral cap each bank has, but that particular thing has been removed. So again, what do you feel will be the impact of this measures taken? And separately, is it like too much of regulatory unease in sort of a cycle has started? Do you feel that it can pose systemic risk in not short term, medium term, but in the longer term? A lot of earlier under the last governor, I believe, a lot of system was tight and higher risk weights. NBFC funding from banks went down like anything. So restoring everything to the, and even giving a lot of relaxation incrementally. Do you feel this regulatory uneasing that has happened, it poses any, stress in the long term?
Yeah. No, I think I have a fairly good interaction with regulators at various times, and I do think that there's a lot of thoughts which goes into any regulatory actions which this institution take, and there are fair bit of learned people in that segment. So I am sure they have given a lot of thought to this. If I can pick up one specific piece, and we'll probably talk about, for example, the 10,000 crore limit to the system piece. You have to see when it came. It came in 2016. When the sector was probably among the at the weakest segment, when there were large scale NPAs which was emerging from the corporate side, banks had taken, banks had a lot of NPLs were emerging from the sector. Banks has taken large exposure without probably understanding the risk involved, and the corporate segment exposure was also overall exposure in the balance sheet was also fairly high. So I think RBI probably wanted to reduce systemic risk at that point of time and diversify some of these lenders toward the market side. That the borrowing should not be concentrated into the banks and they should borrow from different segments, including the capital market side. Probably the regulators perhaps realizes now that the Indian economy needs support for large-scale projects. And the circular is probably constraining that. And now, if you look at the overall structure of regulations and all, and the banks, I think they have a more confidence in terms of their ability to look at the system, intervene at the right time, and even in the balance sheet strength of the banks. So I think they have also stated that this macroeconomic risk will be probably tackled through macroprudential tools. While they have not detailed what exactly these are, but I'm sure more details will emerge at some point of time. Now, looking at the other side, what it entails. Overall, credit demand still remains fairly weak in the system. Apart from few PSUs and a couple of large corporate conglomerates, it is difficult to envisage very large credit demand coming in near future. Also, banks remains fairly cautious, and the last experience is too recent for them. The credit cycles which they have seen. So, I don't see banks jumping over each other to lend large corporate exposure to the corporate segment. I don't see anything changing immediately. The benefit will only accrue when we see the corporates have the appetite and the bank the willingness to step out and the project pipeline is ready. So I think this is more of an enabling regulation, that as and when the demand comes up and as and when there is the appetite in the system, there is enough supply of, and this is not constrained by the bank's inability, and there is enough supply of credit in the system. So that's what. Risk, yes, I think I think that the banks, even if there is a regulatory permit or regulatory restrictions have been moved, I think the banks would need to develop strong underwriting skills, project ability to understand the project execution capabilities, sponsor quality. They have to understand all those things. That the things which led to last cycle, the challenges which were there in the last cycle, I think nothing goes away. Even if they have to take some of these exposure, they would need to develop some of these capabilities so that they are able to service the system. Similarly, the guideline which came on the M&A support. I think if you look at the entire system, with the caveats which have been put on, only 70% could be financed and it could be 10% of the tier 1 capital and all. I do see this as a good step. I mean, why to restrict banks from doing this? This allows them to expand balance sheet, lend to good corporates, earn good fee income. If the banks have reasonable capability to understand the transaction, I do think this could actually help both banks and the borrower to kind of expand and grow both domestically and internationally. So I do see some of these regulations as enabling provision, and it may not be fair to look from a very short-term perspective. It only plays out in medium to long term. But I do think that the Indian economy and Indian conglomerates require this kind of support and enabling provision for them to realize their true potential.
Okay. Since we are running short on time, I will ask a few concluding questions.
Yeah.
First is the government's fiscal relief that it has given in terms of tax IT returns, or in terms of GST rate cuts more recently, and the policy measures that the RBI has taken. Do you feel banks have commented that October was decent in terms of credit appetite, but H1 we saw that credit demand was muted, the credit growth was muted. Do you feel this credit demand is sustainable, and whether banks will be able to go back to upwards of say 12-13% sort of a credit growth that they have been posting over the last 1 or 2 fiscals? SBI, of course, the country's largest bank, just raised their outlook for credit growth from 11 to 12 to 14% for the current fiscal. On the credit growth side, on the deposit side as well, you have seen cycles, and the latest cycle is that the CASA has been going down. I mean, will it become a redundant sort of a product in the long term for banks, and entire thing will be via term deposits or external capital market liabilities they will have to pick? So on credit and deposit growth, and final comments on, do you see any pockets of stress emerging in terms of asset quality? Are there? We saw MFI sector go through a patch through the better part of last fiscal, even in first quarter this financial year.
Yeah.
So on credit, deposit, and on asset quality, or brief comments, sir. Thanks.
So October certainly has been a good month. I mean, if you see this guidance came in September, and we already see that the credit growth has picked up quite a bit. And the commentary has not only come from the banking side. Even if you look at the companies, they are saying that there has been quite a bit of a pickup in demand. The car sales has picked up quite a bit. The two-wheeler sales have picked up quite a bit. So yes, we have already seen that the initial effect of that has reflected in October. Having said that, I think the October it will be probably a bit premature to say that we would see similar exuberance for going forward as well. The October could have been part of the pent-up demand which could have been there, and people might have been awaiting some of these rate cuts, because there was the expectation that there would be some of these announcements would come. So October demand could partly be supporting through the reduction or postponement of demand which might have seen in earlier months in that sense. So, but yes, I would certainly believe that some of these measures are certainly supportive, and we would certainly see better demand from the consumer side and pickup of consumption. How much this really leads to, whether it will lead to the going back to the huge growth I think that we have to wait and see for that perspective. Not to forget that we also need to see what impact does it has on the GST collections. Overall, if it has a detrimental impact, then the government borrowings in the market could go up, and that could impact the interest rates and all. So I think the full complete picture has yet to emerge, and we will probably see some of these in the months going forward from that side. So that is from on the impact of rate cuts and government support on the one side. On the deposit side, yes, we have seen fair bit of I would say moderation in the deposit growth. Whether the CASA will become redundant, I think that's a too strong a statement to make. But I do think that the CASA growth the banks will have to compete much harder to get that CASA growth, both on the CASA, because the companies are becoming far more on the ball, and in terms of managing their liquidity, there is a far more competing products in the market, both from the capital side and liquid funds, and also the float which used to be on the banking side has reduced quite a bit. Similarly, the population in general, or the customer clients in general, are becoming more aware, and they are remitting their float both in the current in the savings account, and because of the interest rate differential, they are happy to put it in the deposit side. So overall, yes, I do think that the low cost CASA growth would remain muted, and we would see the banks moving out different sources of funding, both from borrowing from capital market, commercial deposits. All those things will actually increase in proportion as we move forward. As far as the asset quality is concerned, I think we probably have seen the worst, at least from the banking side. Both on the retail and on the corporate. Corporate side was doing fairly well for a long time. Even on the retail side, unsecured and all, I think the commentary seems to be that probably we have seen the worst, and we'll start seeing better numbers going forward. But I would see that the growth will still remain muted on the banking side on many of these products. Bank would want to kind of tighten their filters, get more confidence before they want to put on accelerator on some of these products. So while asset quality front, I would see probably we'll start seeing improvement. I am slightly more skeptical in what kind of growth we can see on the sound in the short term.
I think I'm through with my current list of queries. I will speak with you, after this. Thank you for your time, Prakash sir. Thank you, our team. For viewers who tuned in, thank you so much, and look forward to more such insightful discussions from the Current Account podcast. Thank you, sir. Yeah.
Thank you, Piyush. Thank you so very much. Thank you, everyone. Thanks for listening. Thank you. Bye-bye.